Hi everyone, this is Michael Ben-Ghiat with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for October 29th, 2022. Here's our disclaimer, you can check that out. And let's get right into the action here. So our market trend report, we've gotten pretty bullish now, and it looks like, we're going to talk about a little bit later about whether the bottom's in or not. But it's looking pretty strong overall. But of course, there are some caveats which we're going to talk about. But for right now, we are in a confirmed uptrend for both the S&P and the NASDAQ. For individual stocks, let's go back. So for the S&P and the NASDAQ, we have a market count of 2 out of 5, which gives us 55% exposure. And the S&P, we have 3 out of 5, that's giving us 75% exposure. There's only one institutional selling day for each of the indexes. So it's looking pretty good. I mean, it's pretty strong, and it's and we're going to take a look at the charts in just a moment. So that looks pretty good in terms of from the index side, but from the individual stocks and the non-index ETFs, it's still, we're still in the red zone. We just haven't been able to get enough traction and leadership to change that. And of course, the index is made up of stocks, and that can make, just following this indicator, which is still red, can make a difference in your actual stock trading unless you're only trading index ETFs or something like that. Okay, so for our investing strategies, we're still greatly beating the QQQ. The buy and hold QQQ is down about 29%. We're down about 9%. And then for the SPY buy and hold is down about 18%. And our market count 1X strategy is down about 12%. So that's looking pretty good. And as the market gets more bullish, if it does, if and when the market gets more bullish, of course, we're going to continue to probably outpace both of the buy and hold indexes. Okay, so let's take a look at the indexes here. I'm going to start with the Dow, just because the Dow is vastly outperforming the other indexes. For whatever reason, it could be just because of the nature of the industrials and the 30 stocks that are in there. We're seeing rotation out of the big mega tech, Microsoft and the other mega caps that are tech stocks that are part of the Dow, and it's rolling over into the other components. And we've really just had a super powerful run. Back here, I actually don't have the date right here, but I think that was a 1,500 point move off the lows, came screaming up right to the 21-day, which is this green line here. And we've just, shot straight up. It was 1, 2, 3, 4, 5, 6 days in a row, and actually closed above the 200-day moving average, which has not happened since April-May time zone. So that's looking actually pretty strong. But we have some, just warnings going on here. Number one, this is still a counter trend rally. The reason I'm saying that is that we have the major moving averages, the 200, which is the black line in the red, are still in downtrends. They're still going down, facing downward. And so we don't have any sign that this actual downturn bear market is over. So at this point, we're getting a warning there that this has probably gone a little too far too soon. Market's just gotten very bullish. It's gone back to its ways of, basically discounting and ignoring any bad news. It's all good news now. It's like the market's like a child, a very young child, and that's what it's doing. It has its little temper tantrums here and there, and looks like we're in the middle of one right now. Now, if we go to the S&P, it's acting, second best, and we've just managed to get above the 50-day. Again, both of these are still in really strong downtrends. Both these moving averages are facing down, and but that's a good sign for the market that we've seen, at least we've broken above the resistance of these key moving averages. Here we got way above the 50 now, so that's not even a problem. And then the S&P just broke above it, where you can see for about 3 days it formed resistance. So that looks really good. And then we have here the NASDAQ, which of course is the home to a lot of these mega caps, FANG stocks that are in other tech stocks have just been, beaten up. And that you can see it's just really underperforming. We're not even near the 50-day yet. And the relative strength line is actually making a new low. So that's not a good sign. This could end up holding back the whole market, or unless less investors just come pouring back into tech. But there doesn't seem to be a lot of reason right now with rising interest rates and everything else. So we have another warning there here. Let's go ahead and just look at the technicals. Now this is improving pretty quickly. You can just see here the percentage of stocks above the 200-day. We're about 35%, which is higher than anything we've seen in this whole chart here, going back roughly a month. And you can see the colors starting to get a little more yellow, getting out of the reds and oranges. Finally, we're starting to see, no, actually we had 2 days. Let's see, we had one here. Yeah, we've had 2 days where there's been more 52-week highs and lows. So that's a little bit of a change there. NASDAQ is getting pretty close to its 50-day, where it was down almost 12% just a couple weeks ago. Now, the number of stocks that have broken out recently and have not broken below the sort of the 5 to 8% sell zone is really rocketing up here now. You can just see this is starting to improve quite a bit just as of a month ago when the market was still in a downtrend. Or still in a bear market. Well, sorry, it still is in a bear market. But when we really were hitting just the number of lows, everything was just really getting pounded down here. But suddenly we just starting a nice, change upwards in terms of the number of stocks that are breaking out and holding, which is a big change because for all of a lot of 2021 and pretty much all of 22 up through the end of September, we would just see this come up and then it would just, they were just selling to every rally. So this is a pretty big change that's going on. Now, whether it's going to last or not, we don't know. But this is the most stocks we've seen on this for a long, long, long time. So that's a good sign that maybe there's a little bit more to this rally than what we've seen before. And then finally, for the up volume versus down volume, you can see here we're starting to get a few days that look pretty good. Less of these ones where the down volume was just swamping the up volume. So there's been a change in the market. We are starting to see the technicals greatly improve. And then also in terms of sentiment, we really got down back a month ago. We were in extreme fear and panic mode. The weekly bulls and bears was very bearish. Everything was just very bearish. And we've now come up, overall, we're actually at neutral. We are not actually hit the greed on the CNN fear greed. That's kind of interesting. It just really pretty quickly came up from extreme fear. And in the space of 2 weeks, we've gone up to greed. The put call had hit a couple times above 1.1, which is usually the sign that when it turns around. And the weekly bulls and bears has now become just bearish. So when you add it up, and the VIX is now coming down too, this had hit in the 30s. So from a point of view, that too has kind of pointed towards, a low. So just to kind of wrap things up, big question, is the bottom in? Well, we do have a number of things that are happening right now that are very bullish. We have the October seasonal bottom. I don't have a chart of this, but the market tends to bottom out seasonally in October and has a nice run through the holidays, Christmas season into New Year's. There's a 4-year presidential cycle that's very bullish. It basically is showing that, at this point we turn up and then we just keep going up throughout the next couple years. Again, all these seasonal things and cycles, you don't trade off them, but you want to see if there's a number of them setting up and facing the same direction or not, because these things they're just they don't happen enough and they're not strong enough that you would actually want to trade off of them. We've also seen the VIX hit that 32 to 35 area. We saw it in the last chart. That's been a turning point in multiple times. This is just a different chart of the investors' intelligence that we show. And this one's showing that we've come down to just bearishness has reached levels. Here's the 2008 bottom. Here's 1994. So whenever we get down here below 1, we usually end up kind of bottoming, at least for temporarily, and we're coming back up. So put these all together, we are seeing the change of bearishness and other work that could, it's pointing to we probably have a bottom in for some time. Whether it's the bottom, nobody knows there. So what's happening here? The markets are discounting a soft landing, it looks like. Or at least the Fed pausing or backing off of rate hikes. What kind of triggered it this week? The market may be getting ahead of itself because it started rallying really when they started getting some comments from the Fed members that they got a little more dovish, and they started seeing, well, maybe we're going too far. But Powell himself in the official remarks have said nothing like that. He's like, we need to stick with this until we see firm evidence that inflation is coming down. And if that has to hurt the stock market, then so be it. If it has to hurt the economy, so be it. We can't let the inflation get out of control. And he doesn't want assets to reinflate. He doesn't want to see a massive stock market rally. That's defeating the purpose. So that, I think, is one of the things that triggered this big rally going on. Plus, we had to hit some of the other technicals and sentiment. So it kind of all converged on a couple of weeks ago when we started to turn. Now, the big question is, are we going to see a recession? If we don't have a recession, the bottom's likely in. The reason I say that is the S&P tends to decline around 20% in non-recessionary bear markets, and which it has, and so that's where we are. So if that's just it, there's no recession, that we've probably seen the bottom. But we've had 2 quarters of negative growth, which is really the official definition of a recession. But for whatever reason, nobody wants to call it that, so they kind of just pushed it aside. I guess they're waiting for the next one to see what happens. The S&P's average decline is 31% in a recession, and the bear markets and recessions will last, usually longer than 1 year, and we're not even quite at a year yet. So this is a big question over here: is that going to happen? The other part of this is whether or not some people are saying, well, this is a bear market, obviously, but it could be just a cyclical bear market within a secular bull market, or is this really a secular bear market that's going to go on longer? And that does, just like we've seen here, we are in for a longer decline and a larger decline than what we've seen. And that's kind of unknowable at this point. The market's living and dying by these reports that come out every few days. And at this point, it doesn't matter what they're, recently, what the numbers are, it's all deemed to be bullish for the market. So, and then, finally, just one other thing too, that's kind of, all the overloved stocks that everyone said, can never go down, the, Apple, Google, Netflix, Microsoft, there's a bunch of those. They've just really been taken out to the cleaners. Most tech stocks, there's many of them are down, 40, 50, 60, up to 90% down. Usually you see this at the end, that not just in what we've sort of seen most of the damage happen in really about 6 months. And then, of course, all the ARK funds, especially the ARKK, those are just, she's holding on these stocks that are in just major stage 4 declines. So that could be, the market could have also discounted much of the damage, and it's already happened. So, we've seen just these huge declines in stocks. So that may be another reason why maybe this market has bottomed. But again, we don't really know. It's going to depend on how pernicious the inflation is and whether or not we start getting any signs from the Fed that they're going to be sort of backing off. One last thing, too. There's a couple on the negative side, the market's just very cyclical. I think I read somewhere that the energy sector only accounted for, I think it's either 2 or 4% of the index. And now people are expecting, because money is just rotating into energy again. And they're saying, that's going to probably jump up into the 20s, where I think tech and related was like 40% of the S&P. So we're getting a lot of rotation out of things, which is also helping the S&P and the Dow to kind of hold up because they weren't as affected by the tech crash. So we're still looking to see, and we'll start seeing this on our individual stock non-index ETF. We still have to get some new leadership. We don't really have anything. Much of the rallies in the indexes are really coming off of beaten down stocks. Apple, of course, is still a huge contributor to the indexes. It had a really big day on Friday. So that's something we need to see. So we're still in this sort of limbo land. I would expect this rally could go quite a bit longer. But of course, we have on Tuesday, I think Wednesday is the Fed meeting again, and we'll have the interest rate decision. Of course, there's some other reports that are going to come out. So I'd say at this point, we're following the system. We're, roughly 55 to 75% invested on the indexes. In terms of regular individual stocks, it's been a little trickier. Many of them just went screaming up the right side of bases and didn't really form spots to buy. It's been very choppy. So if you're not really making any money trading individual stocks, you're kind of with everybody else. It's been a difficult way to get anywhere with that, just because it's been so volatile. The average chart is just all over the place. And of course, if you're trading with any kind of risk control and using stops, it's easy to get stopped out of things. So I say we'll probably have by next week, the Fed decision will be out of the way, and we'll see what happens. But I would say, just looking at the chart, especially the Dow, it's getting a little overextended and maybe ahead of itself. That's what the markets do. So I would expect some kind of a pullback to happen. But the key will be is if it does, is it just going to be a short pullback without any distribution, or is it going to be much more of a heavier sell-off? Now, we don't want to see much more distribution or big selling, institutional selling. At this point, that will probably, a couple more days of that will probably derail this rally. So we'll see. So you just have to keep living within the limbo, and we'll have some more color on the situation next weekend. Okay. All right. Thanks a lot.